So here's the latest economic update. This is for April 2025. Basically, April 4th, we've got our unemployment numbers. So we're at 4.2%. We're up from the 3.4% at the lowest unemployment that we've had, but we've been staying between 4 and 4.2% since May of 2024. So nothing really to report there. Remember that these are always about a month behind, so we'll see in the coming months basically the effect of Doge and tariffs and things like that, but we'll get into that in a little later. So we had better than expected jobs added. We added 228,000 jobs. Basically, we're averaging somewhere about 150,000 jobs, or that was our expectation. So that's good news. The end of March, our consumer sentiment has been at 57, which is down 28% year over year. So that's not good, because when people don't feel good about the economy or keeping a job or things like that, they tend to spend less money, which is why in January we saw such a drop in spending. One thing we did find is that disposable personal income is up 0.9%, personal income up 0.8%, personal consumer expenditures is up 0.4%, so that's good. I also saw that there was a major change from month to month from January to February. So if you look at January, you would effectively see a drop specifically in vehicles and some other goods that aren't necessities. But in February, people bought a lot more cars and vehicles, and you ask why. So on April 2nd, declared Liberation Day by the president, effectively these are considered reciprocal tariffs from the US side, but other countries don't see it that way. So the EU is effectively tariffed with 20%. China was 34%. Then they said, okay, we'll match you at 34%. So then the US raised it to 54%. Japan is at 24%, Vietnam at 46%, South Korea at 26%, Taiwan at 32%, India at 27%. These are the top trading partners that we have, so that's why I listed these, but you can also see the remainder of those as well. Effective April 5th, there's going to be 10% on effectively all imports. April 9th, they will increase the tariffs on the named countries such as these. And why would you do this? Well, there's not as much manufacturing in the United States as there was historically, so the goal is to bring back manufacturing with good jobs to the United States. So that's a good idea. The concern with this is, in the short run, that's going to take some time, because imagine you want to manufacture a car or whatever goods or services, and let's say you don't have that plant ready to go. In a lot of cases, what you'll have to do is you'll have to come up with plans, then you'll have to go secure funding, you'll have to get permits, you have to go with engineers and architects and builders, and you have to get these people together, and you have to produce that building even to start. Then you need all the robotics, and you need all the equipment and tools to go into the building, and you also need to hire all the people that are going to manage all of this. All of this takes a lot of time, not to mention all the training that you have to go through to get people up and running. So don't expect manufacturing to return in a day, a week, a month. This is more like a few years. So it's going to take some time. So this is a long-term goal, not a short-term goal. So what are some of the consequences? Well, when I say I'm going to put a tariff on this country or that country is going to retaliate in most instances and say, you know what, I'm going to do the exact same thing right back to you, and it's going to escalate. That's generally what happens. Or two countries can come together and negotiate better trade deals and say, okay, we'll reduce the barriers of entry for the United States products to come into that country, and that country doesn't need a tariff to come to the United States to give it an even playing field in that way. The other thing is that it just becomes more costly to trade, which then increases prices. Well, why would it increase prices if you're bringing all this manufacturing back to the US? Well, if you manufacture it in the US, typically you have higher labor costs and higher costs overall to produce it here. You may have more machinery, and that might help with productivity, so the unit cost you can drive down if you can make more units in the same amount of time with less people. But in general, if that was the case, they would already be manufacturing in the United States. With a tariff, effectively you raise the price of the incoming goods and services to give the more expensive goods that are produced in the US a chance to be sold. And in doing so, that increases your prices, which then increases inflation. Why is this not always good? Well, I'm just going to take farming, for example. Different climates grow different things better, basically. So the United States is really good at producing corn and soy and pork products and things like that. So we trade our excess, since we're good at producing those goods, with other countries, and we sell them and make money on that. So that helps the US farmer. Some things that we don't produce, we don't really make a lot of coffee beans. We don't make a lot of cocoa. So we don't make chocolate in the United States, or at least grow the thing that goes into it. We don't really have the climate to produce bananas or mangoes or things like that. So we need a trade for those things. So for a lot of these goods, the US just can't grow them, or can't grow them at any appreciable quantity. So it makes no sense to tariff them to try to protect jobs in the US, because it's just going to increase the cost of those raw materials. So tariffs make more sense with cars, cell phones, and computers that don't rely on anything that would be like a climate or something specific to that area. However, when you go to buy a cell phone or a computer now, basically all these components that go into them, mostly a lot of these computer chips, come out of Taiwan, and they'll do so for the next probably 5 years. It's going to take some time to change basically manufacturing lines, especially clean rooms. If you're thinking about buying any of these things, a lot of people are probably going to buy those before the tariffs take effect, or at least before they get escalated and before inventory is sold out at stores, because they have to restock, and when they restock, they'll have to buy it with the tariff in place. Whereas whatever's currently in stock, you don't have to pay the tariff because it's already in the United States. So basically this was done in the 1930s to protect US jobs. And in the 1930s, we had the Great Depression, and it was probably made worse by tariffs. This went to 20% back then, and we saw a 66% drop in trade with our trade partners. So then less of our goods and services were being sold to other countries, which meant less income for the United States. The Fed had the FOMC meeting on 19th of March. Basically, we're holding interest rates at 2.25%, 2.5%. They have a dual mandate of basically maximum employment, which they don't have an issue right now because we're still pretty low historically. Generally, it would be 3 to 6% is typically where we're at in good times, and then it can go higher in bad times. Price stability, we're targeting about 2% inflation. We're currently at 2.8% inflation, so that's still high. So the problem with this is they can't really drop the interest rates if they think the inflation is creeping up even higher. And if tariffs cause increased prices, we'll see increased inflation, potentially having to raise interest. There are some calls to have basically stimulus checks delivered to the United States through Doge savings and other things, depending on what goes on. And that would help stimulate the economy, but that would also cause inflation if you stimulate the economy, but would help us stave off a recession and not have as much job loss. So it's kind of, you have to pick a poison. Do you want unemployment, or do you want higher inflation? One of those two is likely to occur in the upcoming months. So the first quarter of 2025 GDP estimate from the Atlanta Fed is currently at negative 2.8%. This is, the first quarter of a negative GDP. So if you have a second quarter of GDP, which would be, April through June, effectively you're in a recession. So this is what I've been warning about for the last couple of months. I said sometime in the next 12 months, the data looked like we were headed for a recession. Basically, we hit that without the tariffs, but the tariffs are probably going to just bring it forward and make that recession happen quicker. April 4th, JP Morgan Bank issued a 60% chance of recession in 2025. The poly markets have a 60% chance of recession over the next 12 or so months. I always like to look at prior data, realize that all investments have risk and can lose value, and that even though you have prior performance, it's no guarantee of future performance. But it gives me an overall idea of what has happened in the past and is what is likely to occur, but not guarantee. In 2007 through 2009, if we look at the SPY, and Basically, it's the S&P 500, just easier to trade as an ETF. We had $153 a share down to $76 a share. This is around a 50% drop in the stock prices. If we looked at February through April of 2020 during COVID, we had a 27% drop in basically stock prices. If we look when the Fed was raising interest rates, there was also the conflict between Russia and Ukraine. We had a 25% drop over that time period. If you look at the current period, we only had an 18% drop in the S&P 500. Why is that important? Well, if you look at these other instances, you're looking at 25 to 50% drop. So I'm going to say that I fully expect the S&P 500 to drop at least 25%, unless there's a major change in whatever the tariffs are that are going in place. But this is very likely to happen. I don't think we're done with this. There's more pain in the market before this bottoms out. Prior data from recessions, you're looking at an average recession of approximately 10 months. Typical unemployment is somewhere between 6 and 15%, but more usually less than 10% unemployment, unless it was COVID, which was close to 15%, or the Great Depression, which was closer to 20%. But even during the Great Recession, you were around 10 or so percent. So normally, you're averaging around maybe 8% unemployment, or about 92% of people that want to be employed are employed. Realize that a recession in the broad economy, the economy is not the same as the stock market. Recognize that in many of these instances, when the stocks actually bottom, unemployment is still going up. Stocks tend to go up before you hit peak unemployment. So stocks are always looking forward, what's 3, 6, 12 months from now. Whereas the unemployment, people are laying off because of things that have happened in the past. And basically the businesses can't continue to pay people on payroll and they let them go and they go out of business or whatever else, layoffs, downsizing, whatever you want to call it. So recognize that the economy and the stock market are not tethered together. There's a delay between the two. So people always like to ask, what am I doing? Well, I'm still buying the S&P 500. Guess what? It's on sale. It's 18% off. I don't know how much lower it's going to go. I think it's probably going to go further than 25%. There's going to be more pain in the market. It might go as low as 50%, but we don't know. So let's see what happens. But let's say I have toilet paper. Think of toilet paper and stocks similar. I don't need to use this right now, but I'll hold on to it. And let's say last week this was $20. Now a pack is $10. Well, I'm used to spending $20 a week, kind of like dollar cost averaging. So I'm going to just continue to spend $20 a week. So instead of buying one pack, now I got 2 packs. And I'll continue to buy it as it goes down. And if the following week it's even cheaper, well, guess what? This stuff doesn't really go bad. So as long as I'm buying good quality assets, sort of like toilet paper, let's say, and I'm going to use it or it's not going bad, I'm not really worried about it. So I'm going to continue buying those high quality stocks and assets. And in the future, I hope for them to regain what the value is. So I still expect the top 500 companies to still be there. In the short term, S&P 500, I do believe that we're going to hit more than a 25% loss in that. It's probably going to get closer to that 50% mark. No guarantee of the future, but it's probably going to be somewhere in that range. And people also would joke and say, hey, international funds have not performed well in the past. Why would you still have some exposure to international funds? Well, this is why. Well, because those international funds, they're still trading with other countries with free trade. Just might be that they're not trading as much with the United States. So they may outperform the S&P 500. I'm also, now with that remaining 10%, buying some bonds. If you remember that bonds have an inverse relationship with interest rates. So if we hit a recession, it is likely that we'll have, QE or quantitative easing, lower interest rates, things like that. So if that happens, that increases bond value, but reduces bond yield. So that's why I'm buying bonds. I bought TLT call options. This is basically 20-year bond options for 2027, which I've talked about in prior videos. I've also bought a small percentage of basically UVXY. This follows the VIX at about 1.5 times. And I bought that at $21 to $24 a share, which I shared a couple of weeks ago. And I'm now at $41.45 a share. So that's up over 72% in a short period of time. This is something that I'm not going to hold for a long period of time. I also have a 30% trailing stop on this because it goes up really rapidly and it falls like a knife. So I can't watch this at all times while I'm at a computer or, while I'm working a normal job. So I just automate that. So I have a 30% trailing stop on there. And then for the VIX, what is the VIX? So the VIX is basically a volatility index. So think of this as when people are fearful or there's major concerns and instability, the VIX goes up. So I'd say that this is a period of time where the VIX is going up, and it's going up very rapidly because people don't know what's going to happen on April 5th, April 9th, and then how other countries are going to respond. So this is pretty bad. The last time I did this was in February through March of 2020. It returned about a 400% return. Again, no guarantee that prior performance is the same as future performance, and it can lose value, and it can lose value very rapidly. And I like to remind you that, any money that I need in the next 5 years, I'm going to have high yield savings or CDs. Any money that I don't need for at least 5 or 10 years or more, generally I'm going to invest it in the S&P 500, international funds, some bonds, things like that. If interest rates are at 0%, I don't invest in bonds, but if interest rates are high, I invest in bonds because when the interest rate comes down, effectively the bond value goes up. And I like to hold at this point, especially if I think I'm going into a recession, I like to hold maybe 6 to 12 months of cash on hand with, high yield savings. That's in a FDIC account. Basically, that's an emergency fund in case somebody loses their job or anything like that. Typically, when I don't see a recession coming, it might be closer to like 3 or 6 months, but I'm going to keep a bit more cash at the moment. And when I think that the market is bottoming out, I'm going to take a lot of that money and deploy it in these same stocks. I'll wait for them to go a little further. And I'm still dollar cost averaging into these with every paycheck. I never know where the bottom actually is. So as it's going down, I'm still investing. And as it comes up, I'm still investing. So that's where I'm at. If you enjoy financial topics such as how to make more money, how to save money, how to invest, this is a channel for you. I also cover how to start businesses, and there's a free Discord channel if you ever want to talk. So thank you for watching. Please subscribe and have a great day.